Welcome to the Value Builder Podcast, where we focus on real estate with a value-add mindset. Real strategies, real operators, real outcomes. Let's dive in.
All right. Welcome, Value Builder community. Today I have a special guest, Nick Lares. He is an insurance specialist, and he has a wealth of knowledge about insurance. Definitely many of you who are listening, including me, had enough pains and struggles getting insurance. In my personal experience, it used to be that you have the fear of getting debt approved or maybe not really raising the equity. But in the last 3 years, I think that more challenging was sometimes getting the insurance binded, especially if you're buying in Florida or whatnot. So with that, I would like to briefly introduce Nick, and then I would like just to go in a Q&A so we can educate my audience and myself and all about insurance, about the captive insurance, self-insured, the pools, and stuff like that. So Nick, welcome to the show. If you can introduce yourself, your background and where you're coming from, so we can get familiar with that, and let's get in the insurance world.
Cool. Yeah, no, thank you for having me on. And I wouldn't consider myself a self-proclaimed insurance guru yet, but what I can say is that at least I have enough to make insurance fun and exciting for the first time. Typically, when people hear about what we're doing and what InsuR3Tech offers to the real estate industry. So hopefully you can bring that to your audience today. Yeah, and my background, what I tell most people is no one really grows up and says, hey, I want to be, Jake from State Farm when I'm older. So, my intro into the insurance world was more so kind of by accident. I was playing baseball growing up. I was a collegiate athlete, planning to get drafted my senior year in college, and ended up not being, the Giancarlo Stanton or Bryce Harper of the world, if you will, where I knew I wasn't going to be getting paid millions of dollars, to go and play a game. So I had to essentially pivot and figure out, okay, well, now that I'm not doing that, what do I want to do for the rest of my life? It was a very hard transition to figure that out. So I decided to just test out a bunch of different things. I ended up finding my way into the startup space in South Florida, in Miami and Fort Lauderdale, where I was from, and was introduced to a lot of cool teams, a lot of cool people. And I was headhunted to work for a company by the name of Kaseya. So most people don't know Kaseya unless, I guess, they're an avid basketball fan. They do own the naming rights of the Heat arena, where the Miami Heat play out of. And they're a very large IT cybersecurity company. So, back in 2019, 2020, the cybersecurity world was very, very magnetic for somebody just graduating college, and decided to give it a shot. But I was the last person hired at Kaseya before the first COVID case hit South Florida. So, as a saying goes, last one in, first one out when it comes to the employment record. So I was furloughed within 3 months of getting my first job out of college, and was sitting around trying to figure out, great, that was a terrible first experience of in the job market. Now what do I want to do? And with the world being shut down, it was a very hard hiring market. And my best friend growing up at the time, his family is third generation insurance family. So, when you talk to most people in insurance, it's either, my family did it, so I do it as well. Or in my case, I got into it by accident, and he said, hey, we're doing this really cool thing. We're actually insuring Amazon across the US. Their delivery van market was starting to ramp up during COVID, and they were relying on specific agency partners to help insure their entire network. So he said, hey, we're growing really big into the space. COVID's taking off. The Amazon logistics network is ramping up. We could use some help. So I said, sure, got nothing else to do. Let me give it a shot. Fast forward 4 years later, we're one of the largest insurance brokers for Amazon's logistics network. We were working with very large insurance companies, like Allianz, Liberty Mutual, all the big ones that most people know. But after 4 years, very similar to what's going on in the Florida and California markets and insurance right now, carriers ultimately decided, hey, we don't want to be in this space. We're going to back out. So here I was with hundreds of customers, millions of dollars of premium combined across all of them, and telling them, hey guys, in 90 days, you might have to shut your business down because you might not have insurance. So it was a really difficult scenario that we were faced with. Lo and behold, as a person just getting involved in insurance, I was freaking out. I was like, man, we don't have a product to sell. What are we going to do? But there is a option for, alternative risk structures where if you don't have a traditional insurance company who wants to insure you, if you're big enough at a large enough size and scale, there is a way and means where you can technically become your own insurance company. And the federally approved way of doing that is what's called captives and self-insured or risk retention groups. So I learned all about that market within a 90-day time frame. it blew my mind. As somebody who was selling a product for a third-party insurance company to my customers, I was put in a position where I was now selling them a product that they owned themselves. And the value of that was just awesome to me. My customers came to me and said, hey, why wasn't this plan A? Why couldn't we just band together, build our own insurance company, or you build the insurance company for us, but we essentially retain ownership of it? I would have gone into this route from day one if it was presented to me. And it opened up a lot of the issues and the embedded networks in the insurance market that are all very traditional. They're all old fashioned. And people ask me all the time, hey, how come no one's ever presented this to me before? Or, hey, how come no one's ever told me about this? And honestly, the real answer is just, hey, no one's ever had a need to tell you about it otherwise, right? The traditional market works. We go from there.
Good question. So at that point, your customers, Amazon itself, Amazon third-party vendors, drivers, suppliers, who are your customers at that time?
Yeah, so Amazon in the beginning outsourced all of their delivery to third-party contract providers.
Mm-hmm.
So every Amazon van, right, that had the Amazon logo on it was actually operated by a third-party delivery company, very similar to like FedEx, CSP routes, that same structure.
But
So
it's
it was
still,
all
in
independent
my understanding, these are not massive companies. These are, local, small to mid-sized companies, right?
Yeah, 50 to 100 employees, 40 to 50 vans, operating out of pretty much every city in the US, wherever Amazon can deliver. There's an independent company who's delivering for them in that specific market. So we had, at hundreds of those exact customers, I mean, we were having millions of dollars of insurance premium across all of them. And right, people explore captives all the time, but the biggest, downside is usually, hey, I'm not big enough to do it on my own, or I can't get, somebody to backstop me or reinsurance because I just don't know enough about the market as a whole. And that's essentially where we came in, where we were able to create what's called a group captive for our delivery providers, where each individual operator on their own, not big enough to create a captive, but all of them together, and you combine them, all their premium as one, you split the captive on a pro rata basis. So everybody gets essentially their share of what they pay in of one single underlying captive, which is called the group sell captive structure. So that's what we were able to build. And once we built that out, me as an insurance broker at the time, my job was done. Right? As a broker, I rely on insurance companies to essentially pay me a commission to sell their product to my customers. But now that I built my own customers, their own insurance company, I had nothing to sell anymore because they all had their product. And once you start and you go to the ownership route, you never go back to renting or leasing from somebody else. So all of my customers were essentially never going to leave their own insurance company. Why would they? It doesn't make sense. So I decided, hey, I've got to look at an alternative market. What option is out there for me? And it was, again, right around the time when Florida and California insurance carriers started to back out. So that was a signal for me where, hey, real estate might be a good option, where let's go and build a group captive for the real estate market. And here we are.
Now, but do you mind if I would just go back a little bit? And again, including myself, so they heard about those terms, self-captive, self-insured, but probably it will help if we can understand a little bit better. So let's say captive insurance, this is technically self-insured product, right? Or it's your own insurance company. But you're small enough, then you go to sell captive, which I think it's almost like Chile called, like with many companies. And this is sell captive. Is that risk isolated to your company when you say pro rata share? Or if my loss is larger, do I pass that loss to other neighbors in that pool? How does it work?
Yeah. So, there are definitely different flavors and styles of captives. Independent sell captives, meaning, right, one insurance company owns or pays, right, the premiums to the company that's insuring themselves, right? So you got a very large REIT or institutional fund that's got millions of dollars of premiums that they spend every year. If they set up their own independent captive, right, their premiums go to pay for their own claims and it doesn't go to anybody else's. That's one captive structure we can work with. The other one is the group sell, where yes, everybody's premium essentially goes into a shared bank account, if you will. And at the end of the day, if any claims or expenses arise, it is claimed against that same shared bank account. But then at the end of the day, whatever is left is essentially redistributed back to everybody as almost like an LP profit distribution at the end of every calendar year. So in the group sell, yes, unfortunately, you are essentially at the helm of how the entire pool performs. based on your performance back, but at least it is a step in terms of retaining some form of equity on the insurance side without having to fund it yourself or without having to essentially spin up your own captive if you don't have the volume to do it on your own. So it's almost like a best of both worlds, where it also protects you in the event you have a bad claim or really catastrophic loss. You can still, in some cases, get a return at the end of the year on your premium. If the rest of the pool does well, you're still going to get a profit distribution. You're not fully dependent on your own performance to dictate your returns.
Makes sense, yeah. All right, so a couple more things right away pops in my head, right? You have a pool of owners called 100 owners, and you concentrated in Midwest. And what happens, you probably, if you're in Chicago, you saw what happened a couple of days before. Big tornadoes just passed through here, right? No, and I don't know how much damage was here, but it was unusual. I'm pretty sure it was unusual damage for insurance companies. Looking at an yearly basis, let's say on a decade basis. What happens then? What happens then is our pool collected premiums is not enough to cover the damage that happened once in a decade.
Yeah, totally. So think of Insur3Tech as almost like a Build-A-Bear workshop where we can build specific captives for specific portfolios, right? Obviously, we have group cell captives already structured and built up that are operating. In that scenario, they all have what's called a reinsurance backing. So most people don't realize this. They think, oh, I give my money to an insurance company. They hold on to it for me with thousands of other customers. And then in the event claims happen, they pay out.
Yeah.
But if they run out of money, most people think the insurance company takes a loss. That's actually not true. Insurance companies have what's called a reinsurance company, right? So that's an insurance company for an insurance company. So in the event, say State Farm, if they run out of money that they collected from their customers in premium and they have to continue paying out claims, there is a second insurance company who steps in to cover those losses from $0 down. So technically, State Farm shareholders aren't having to pay additional money out of pocket. There are no additional assessments or capital calls. There's just a second entity that comes in and covers the rest of the damage. So most insurance companies are structured that way, where they will either generate a profit in the year of a good claims year, or they're not going to lose any money in a bad claims year. Somebody else is going to cover it for them. Right. So that's exactly how our group captive.
Who are these giants? Is that governments? Is that Lloyd's of London? Who are these reinsurance companies who can take that risk?
Yeah, I tell people
risk.
Just watch any golf outing on a weekend, and you'll probably see them sponsoring a lot of these golfers. It's the Swiss REs, it's the Zurich RE, right? Yes, Lloyd's of London is one of them, but there's a lot of private reinsurance companies. They're all based out of London, Turks and Caicos, Cayman Islands. The market is very cloudy, and a lot of people don't know about it. But once you see one of their logos or their brands, you'll recognize them immediately, and you know exactly what they do.
So these guys who are thinking decades, not in a 12 months risk.
Yeah. Insurance is very relatable to a casino, right? Where it's obviously odds, there's risk at play, but the general rule of thumb is the house always wins in the end, right? It's not about, hey, they lost on your single blackjack hand, but over time, right, they're probably going to end up winning because the odds are in their favor on the long run time. So the only thing they need you to do is come to the table and play, right? Obviously in insurance, everybody technically has to have it. I like to say there are 3 things guaranteed in life, death, taxes, and insurance.
Yes.
So people still have to pay for insurance, and you want to get to the side where you are on the ownership side, or you want to be the house as soon as possible, because the more you can start building up that equity or the profit return on the insurance side, the more it compounds value over time. And that, right, people in real estate understand the value of compounding. So the sooner you can join in some form of a captive at any capacity, the better it will be for you in the long run in the end.
Totally makes sense right now. A lot of clarity. All right. So one thing, objection out of the way, that was in my mind that, I wish I had like live comments from our listeners. Another thing that often comes to my mind about captive insurance, how will my lenders react to it, right? Let's say, especially if you're buying in Florida, will they give me a loan if I come in with captive insurance? Maybe just moot point. How does it work?
Yeah. So the biggest objection we have from lenders right now is most captives don't retain what's called an AM Best rating. A lot of lenders require their insurance carrier to have an AM Best rating paper. So we are in the process of having our final approval to have an AM Best rating finalized, hopefully by the end of August of this year, 2026. So come the start of 2027, We should have all approvals to be accepted by any lender across the US, as well as Fannie and Freddie, right, for anybody doing multifamily deals. But for the most part, local lenders, if you provide them with additional information, right, we have the reinsurance company balance sheet we can offer. We have certificate of approvals from the Department of Insurance. A lot of times, if you can provide them with that information, they're totally fine with having a captive insure the property if they can have some additional information behind the captive, which we are willing to offer to any lender who requests it. So a lot of our commercial, real estate investors work with local lenders, and we're approved, I'd say, by at least 90% of them in terms of being able to insure the loan. So that hasn't been a big issue for us right now. The biggest issue for us is just if you have a multifamily property on an agency-backed loan, unfortunately, we just have to wait till we get our approval, but everything else has been pretty free and clear for the most part.
Makes sense. All right. This is great. I know you mentioned you have events where you educate operators, but if we can try to pack it in the next, 10, 15 minutes, just highlights. So what does it take in terms of cost, energy and paperwork? And let's say I'm looking, from my lens, right? We're using insurance brokers. We were approached quite a few times to do a blanket policy for all properties.
Yeah.
And it's a few dozens of properties, but, it seemed like the lift was not worth the squeeze. So I don't know if you can enlighten that aspect, the cost, the time, what does it take, to get it done? Let's say for small to medium size operator, if you, talking someone, who's managing 10 to 20 buildings, how does it play out?
What's the lift? Yeah. I mean, we operate very similarly to like any traditional insurance company. So, right, our rates are filed just like all majority insurance companies are with the Department of Insurance. So our pricing falls very in line with the market. What we like to say is, traditionally we're going to be 10 to 15% cheaper than what you're probably currently paying, because we can go direct to you, the customer, without having to rely on a broker who's essentially just earning a commission on top of the premium. So for the most part, people come to us and say, hey, what do I need to quote? The most part of what we need is just an SOV, right? Statement of value, where it's an Excel spreadsheet of all your properties, the value you need insured, any information regarding when the property was built, the occupancy type, is it retail, self-storage, industrial warehouse. And then from there, we can set a price for you. We don't do a master policy. I mean, that's really just a volume discount at the end of the day. We do price each property according to its risk, because we want to make sure everybody's paying a fair share in to ensure all of our customers and our members, you are protected fully at the end of the year. Our goal, what I tell people is, you got to think like an insurance company owner now, right? Your goal is not to offer people the cheapest price. Your goal is to generate a return at the end of every year, right? If we can consistently deliver returns, that means our group is performing well. That means we can lower our reinsurance costs on the back end as our volume grows and create a stable and low cost insurance product for the duration of everybody's investing career. We don't want to come in and offer super cheap rates and bring people on who just want the cheapest costs, because that's going to turn into a non-performing well insurance company. And you, as a co-owner of the insurance company, want your company to do well, right? So I tell people, hey, if you want to come for us for a discounted rate, that's great. We still want to offer that. But we want owners and operators who approach insurance as low risk, as I'm not going to just try and file a claim the next storm that comes by. I actually see this as a value add, where I'm putting my insurance policy with other owner operators who are going to actually use insurance for what it really is, right? Usually very large catastrophic claims, but anything that's minor, right, cosmetic, they're paying out of pocket, and they take on, a $10,000 to $50,000 deductible, whatever price you want it, we can essentially customize it. But I try to have people think differently. Instead of viewing me, right, or Insur3Tech as a partner that you work with, yes, we are, but you're no longer a customer, right? You are a customer and a co-owner of the asset that you are paying your insurance premium to. So start to think differently about how you approach it, instead of how can I just get the cheapest cost, right? Because at the end of the day, that's what our product delivers, profit returns.
Yeah, so in a sense, you are setting up those groups. I was in the mindset that if I do that, I have to almost recruit, which I think probably maybe that would be even the route to go. When I recruit a group of people who I know that have similar mindset how you operate the buildings. For example, we're trying always to not necessarily minimize the premium, but we're trying, for example, was to get the highest deductible, because we never try to file any frivolous claims. So that's the only thing, we believe we get the premiums, but, to attract these same people to get in a group. So you are putting us in a group, or you looking for the operators to set up the group and come in with a group?
It's customizable and flexible. So, right, our goal is just to have everybody in a form of a captive at any scale. So we have different conversations. Sometimes, right, people in your scenario, hey, I've got a couple other owner operators in mind that they're very safe, and collectively our premium is, $5 million annually. You guys are at a scale where, yeah, it makes sense. You can build your own captive. All your premium dollars are retained by you if they're not used. But not everybody's in that scenario. So I'd say the first step is at least just have a conversation with us. Let's talk and see. There are a lot of people, I'd say a majority of our customers don't have a lot of owner operators where they have a big enough scale to become their own captive carrier. So, I'd say if you or your network collectively is paying less than $5 million a year, it probably makes more sense to just join one of our pre-existing captives that are already set up, where you just become a pro rata, right, co-owner of the existing cell. So at the end of the day, whether you're in it on your own or you're shared within somebody else, the goal is the same, to essentially give you some form of profit returns at the end of the year. Now, right, yes, we can make the case where you can start off in the group cell. If you come in and you say, hey, I don't have anybody in my network yet, but I just want to be a part of a captive, great, we can start you off in a group captive. If you build up your network over time, or your own portfolio grows to a scale and size where, hey, you're actually big enough now where you can become your own captive, we can always spin you out and put you in an independent captive cell afterwards. It doesn't have to be all or nothing up front. So there are ways where we can move back and forth between different structures, right? There are some scenarios where we bring in somebody in an independent cell captive, right? We give them their own cell, their own bank account, their own premium, pays for their own claims, and they start performing not as well as they thought, and their returns are below the average return that our group cell is offering. And to that person, hey, let's go into the group cell captive, right? Because you're constantly on the threshold where, yes, you have claims, you have losses. And what we tell people is, you want to know, what does my profit ratio look like, right? So for every dollar you've paid an insurance company in premium, how much have you claimed back against losses? If that number is over 30%, then you're probably better off being in the group cell captive, because the more diversified the pool is, the higher the return should be. Right. So if you're not the best performing operator, but you're still profitable, group cell makes sense. If you're somebody who over the past 10, 20 years has never filed a single claim, for certainty, right, that you're not going to probably file a claim for the next 10 to 20 years, and we can show that historically, then yeah, we can put you in an independent cell if your volume is large enough to do so. But again, at the end of the day, we just want to get everybody into a captive as soon as we can, because we just think the traditional insurance product, it's really just not the best value. And with captive programs being around where anybody can get into a captive now, you don't have to deploy upfront capital. Your premium dollars get you a policy and a pro rata stake in the underlying insurance company itself. So it makes no sense when you're presented with both options why you would just give somebody else your money with no option of a return when you have a captive cell waiting for you, right? Just to quote your portfolio tomorrow, whenever it comes around. And the biggest question people ask us is, great, well, if you're returning all of the money back to me, where do you guys make your money? And I tell them, the same way every other insurance company makes their money, they invest your premium and keep the return, right? So that's essentially our stake. We also have agreements with the reinsurance companies on the back end where if everybody performs well, we almost get like a bonus, if you will, where we're incentivized when you guys do well. So we want to bring on good owners and operators because our bonus essentially depends on it from the reinsurance company we have backing you all. So we are incentivized, unlike, traditional brokers. Whether you file a claim or not, they're getting 10 to 15% off the top of the premium that you pay either way. So they don't really care if you're performing well or not, whereas we do. So we want to make sure we're bringing in good owners and operators. And the second question a lot of people ask me is, hey, well, how do I know if the people I'm in the pool with are actually performing well? Are you guys just letting anybody and everybody on? And the answer is, hey, it's sometimes very hard to predict risk up front. Historical performance is not always indicative of future results. So what we tell people is, hey, we're a lot more lenient to let people in the program, but we're very strict. If somebody is consistently underperforming, they're constantly filing claims when they should be just investing in R&M and maintaining their properties well. If we come to find out we have somebody in our captive who is a high-risk operator, we still operate on renewals. And if somebody is not performing well, we can always non-renew them and ask them to leave the captive. So we're always essentially evaluating our group on an annual basis, making sure we only have people who are rowing in the same direction in the boat. And if they're not, then they're essentially just asked to leave. So that's one thing that we do to make sure our program is consistently delivering returns back to our customers.
Makes sense. Now, and one more thing on the numbers. So you alluded that probably in this type of setup, you can expect 10 to 15% lower premiums, but that's not also counting distributions that come in if there's no events, right? And then
that's right.
That's pretty much gravy on top of it. Okay.
Yeah, totally. So our returns, across all of our captives, we've got a bunch of different ones. The average lifespan of our captives right now is about 3 years. The oldest one goes back 7 years. The most recent one was built early this past year. On average, our captives are returning anywhere between 20 to 30% of premium back at the end of every year.
Wow.
So I tell people to expect, hey, on top of 10 to 15% price discount up front, you can also expect 20 to 30% of your money back at the end of every year, to where your net annual cost savings on your insurance program is going to run you 30 to 45% annually.
Yeah.
Right.
Those numbers you saw even in Florida, in high risk markets, in California with fires.
Yeah, that's across the board. Thankfully, we've had a very mild claims year the past few years. A lot of those hurricanes that came by in 22 and 23, since then, it's been pretty clean. So this year, we're expecting to project about a 33% return back to our customer base this year if everything continues to go according to plan. So, it's crazy what happens when you bring people who are not trying to game the system, who are not trying to commit insurance fraud. And when you put them together in a pool, they drastically outperform the rest of the market. Right. And that's one thing that I love about captives as well, is it attracts a person who is tired of the traditional insurance market where, hey, I feel like I'm subsidizing 10% of the market and I'm part of the 90% who is a clean operator and doesn't file claims. Right. If you carve those two buckets of people out separately, the 90% of people who generally don't file claims are going to drastically outperform the 10% of people who retain or make up 80% of the claim volume that exists in the insurance world, right?
Yeah.
Everybody knows of the horror story of, I know a guy who a storm came by, he called a public adjuster and said, hey, come take a look at my roof. And then, they've got a brand new roof, they got a brand new kitchen, they got 2 brand new bathrooms, and they're knocking on their neighbor's door and saying, hey, do you want my adjuster to come look at your roof too? I just got a brand new house. Right? If you can carve those people out of the captive program, you're going to get a drastically different insurance company at the end of a 10 to 20 year span. Right? And that's exactly the type of customer who we're attracting and why we're able to offer those returns. Because if you take out the fraud in the market, not only does it lead to reduced claim activity, it leads to less litigation costs, which are actually, in my opinion, the real driver of insurance costs skyrocketing, because people are filing fraudulent claims. So insurance companies are hiring litigation lawyers to fight these fraudulent claims, and it compounds the expense side that the insurance companies are facing. If you take out the fraud, you take out the litigation, you're going to have a totally different insurance company at the end of the day. And if I were an investor, I'd rather invest in the company that doesn't have fraud and litigation, right, in their customer base than the one that does 10 times out of 10, right? And thankfully, the captive structure gives you that opportunity to become a co-owner of the insurance company without having to deploy any other capital other than your premium alone. So I tell people the current insurance market is just littered with a lot of disincentive and misaligned incentives across, right, the outcomes of the industry, where captives really just align incentives and drive positive outcomes for everybody involved, which is a great structure to be in.
Yeah, anecdotally, we made a decision in 2024 to exit Southwest Florida market because we had property, but we didn't had a single claim because of those storms. But we just could not handle the mess of insurance premiums going from $1 foot to $3 a foot and not getting at the closing table. And we're just like, no, it's just too much. Yep. And we actually were technically almost like a victim of that.
Yeah. And then that doubles down. One other great thing about the captive is I tell people insurance companies are not in the business of real estate. They're in the business of insurance, right? So if real estate owners and operators, they know what their property is worth. They probably have, if not employees, a network of individuals where if something goes wrong, they can call them, they can fix it in 48 hours for the cheapest cost and move on, right? if you get an insurance company involved, everybody knows the price of everything goes up.
Yeah.
The time of everything slows down, and it drags into a pain in the neck where some people just don't even want to use an insurance company when they don't have to because it's such a pain in the claims process, right? For a captive structure, when you are a co-owner of the insurance company, we listen to a lot of the stuff our customers tell us that they're going to do when it comes to filing claims, right? So we have what's called more so desk adjusters rather than field adjusters, right? What that allows us to do is enable our customers, hey, if you can fix your property cheaper than what we can send anybody else out to do it, go ahead and do that, and we'll reimburse you directly for the bill, right? What that does is it reduces the loss ratio of the insurance company because
This is so smart.
instead of a $20,000 claim, it's maybe $10,000. You get it done in 72 hours. We're going to send you a check for the bill and you keep going, right? Instead of, hey, we have to send somebody out to inspect it. We got to make sure the damage is there. We got to draw up an estimate that's going to be 2 times the costs, right? So there are a lot of other minor things, again, that's just 2 to 3% better that stack and compound across the captive structure, where our customers love dealing with our claims team because, one, your claims team is your customer, right?
Mm-hmm.
The claims team of an insurance company is technically your enemy. They don't want to pay out claims. So anything you send them, they're going to drag their feet. They're going to say, no, we don't think it costs this much. We're going to draw up a second estimate. And they are not incentivized to pay out claims at all costs because that means their shareholders are losing value.
Exactly.
Right. In our scenario, since our customers are technically our profit shareholders, it's, hey, do you want your money now or do you want it later? Which one is best for you? So when you just create that structure, it makes everybody, one, our customers and our members combined, because you're also now dealing with other owner operators who know how to fix their property, who can get it done cheaply. And again, right, it lowers the cost and offers a higher return at the end of every year back to everybody. So it's just a great situation for everybody involved again.
That's amazing. Great. A lot of information, Nick. I really appreciate that. Definitely, you gave me a lot of clarity. I'm pretty sure listeners learned a lot. So with that, where can people find you and learn more about it or connect with your company? What would be the best way?
Yeah, I mean, our website, has got a lot of great information. So if anybody wants to go on Insur3Tech, so it's INSUR3Tech.com. I'm pretty active on LinkedIn. If anyone wants to look me up, Nicolas, Nicolas, Lares, Lares, I'm sure you'll find me on LinkedIn. Or you can just send me an email, Nicolas@insuretech.com. I'm happy to respond and help anybody out. And I just recommend, again, if you're curious about captives, if even your renewal is coming up this year and you just want an alternative quote compared to what you've been getting from your traditional broker, just send us an email. Happy to quote it out for you and just have a conversation about what a captive looks like. Because I can guarantee you a lot of people have these myths that, captives aren't right for me. I'm not big enough. Or, hey, they're not reinsured, so I don't want to bring on any additional risk. None of that applies when working with our captive. So, have the conversation and we can go from there.
Awesome. Thank you, Nick. Really appreciate that. Please reach out, guys. That was very informative. Thank you very much. And I hope to
thanks for
have
having
you
me, Saul.
again on the show.
You've been listening to the Value Builder podcast. For more strategies, stories, and episodes, head to valuebuilder.co or subscribe on your favorite app. Always make it better than you found it and keep adding value. See you in the next one.